Hey guys, what's going on? This is Nolan Sammer with BankLikeYourBank.com, where we teach people how to use the infinite banking concept to finance everything that they do in their life. And so what I wanted to talk to you guys about today is how do we create this vehicle that has uninterrupted compound interest? We ask about it all the time. It's something that's very foreign to a lot of individuals because it's something that we don't ever think about or know or even hear about. Think about if you have $100,000 in your bank account and you take out 40 of it to go buy a truck, you've only got 60,000 in there earning 0.04% in your account. Well, with infinite banking, actually, we're able to change your mindset and think differently. So when you pull from infinite banking, we're actually not pulling our money out of our policy. We're actually using the insurance company's money. And our money continues to stay working in the background as if it never left. So let me just explain to you really quickly how this works, because the huge mindset shift for me, at least, was when I think of any type of leverage, I always think of like it in real estate. But what we're talking about here is all in the nature of the collateral when we take a policy loan. Let me explain to you guys how this works. So if we have a T-chart, almost like in accounting, where we have two different columns here. On the left column, we're gonna have cash value, and on the right, we're gonna have death benefit. And so again, we don't really use this life insurance vehicle for death benefit, but it's simply just something that comes along with what we're using. So let me explain something. Let's say that over the last 5 years, you've put in $20,000 a year into one policy, and you've got around $100,000 of total cash value that you've put into this policy. Well, on the other side of the coin, on the balance sheet, you're going to have about $1 million of death benefit. Again, we're not doing this idea for that, but it just comes along with it. Let me show you. So we can see here what we have is $100,000 of cash value built up in this high-powered checking account, and on the other side of the balance sheet, again, about $1 million of death benefit. This is how we get this uninterrupted compounding effect. Let me show you. So when we borrow money from our policy, we're not removing our $100,000. It's the insurance company giving us a loan based upon our death benefit. So this is where it gets really cool. It's, again, the nature of the collateral. So let's say that you have a vehicle, or you have a piece of real estate, or you find a cryptocurrency that you like. Whatever it is, you can take this money and use it for anything. There's no rules. Uncle Sam is never telling you what you can and can't do with this. This is 100% a line of credit that you own and control. So again, let me explain exactly how this works. Let's say, for example, you have a vehicle and it's a $40,000 car that you love, that you found at the dealership. You're going to go down there and purchase it with cash. We're going to take a $40,000 policy loan from our life insurance policy. Now, again, the insurance company just writes us a check for that $40,000. So look here. If we have one thing happen to a balance sheet on one side, if you guys are accountants out there, what happens to the other side? We got to subtract from that side too. So we do they basically give us almost like a prepayment of death benefit. And so our money, our $100,000, is still growing in the background, earning as if it never left, because they gave us almost a prepayment of death benefit. So again, for the people out there, we're not doing it for death benefit. But again, let's say that you happen to be in the jungle and you get hit by a blow dart and pass away. Your beneficiary is not going to get the $1 million. They're going to get the $1 million minus the 40 minus whatever's left in cash value. So look at this. It'd be $1 million, so that's $960 plus, what is that number? $60,000. So if you look at this, you're going to end up getting 1.4, or what is that number? What is that math? Not very good at math, but you understand what I'm getting at. The whole point is, your beneficiary is able to retain all of the death benefit money plus all the cash value that's left over. We're not doing it for death benefit. We're just using that as the collateral to our cash value. So that's what allows this number to continue to earn in the background, growing as if it never left. If you want to learn how to use infinite banking to finance everything that you do, click the link below in this video. Let's book a call. Let's have a conversation how you can begin to implement this idea and this strategy in your business. Thanks, guys. Look forward to seeing you on the other side.